Alrighty, people, let's get ready for Fed Day. Yes, the most anticipated day of the month, I think. 87% probability that they're going to be raising 25 basis points. Let's just say if they come out and they say, we don't need to do it, I think the market's going to take that as good news. I think they're going to go ahead and raise that 25 basis points. The market's going to be like, okay, now what does Powell have to say? If Powell's going to talk about holding rates steady now and potentially reducing, well, then the markets might perceive that as good news up until later. Now, if we just take a look at the probabilities of rate hikes, you can see that they raise here and then they hold it. Okay, we've been talking about this May, June, July. Okay, the probabilities are favoring, obviously, holding it there. But the base case for the Fed was to hold them higher for longer, right, to bring down inflation to their target of 2%. Okay, now what I'm starting to notice here is the probabilities for rate hikes, rate cuts, are increasing. So you can see the probabilities over here start to look into September, November, December. You see rate cuts. Now you got to ask yourself why, and you can even see the probabilities of potential 50 basis point cuts increasing. So you got to ask yourself, why would the Fed potentially cut faster? Well, most likely something in that case would have had to have broke, and that would not be good for the overall markets, right? That could be potentially what we're seeing unfold here with the debt ceiling debacle and even these banks. Speaking of banks, remember, banks don't like inverted yield curves. You can see the 10-year and 3-month inverted to 180 basis points. That is a new low here in 2023, and we haven't seen these numbers since the 80s. Meanwhile, you can take a look at bonds. What did they do today? They fired off like a rocket ship. I was happy to catch that move. I sold a little bit into it, trading around a position. That is what I personally do. So it did seem like there was a flight to safety today as the S&P 500 got crushed on that distribution day. You can see gold, also a little bit of a flight to safety. It was up 1.56%. That's a pretty darn strong move in gold. You can see the dollar didn't really do anything, right? I've been focusing on the dollar because of its inverse correlation to many assets, but I've been focusing now a little bit more on bonds because I feel like the flight to safety play would be more here. And when I look at like stage analysis of the business cycle, I think that we're in stage one, in the early parts of stage one, and that's where you see commodities go down, stocks go down, and then you see bonds go up. And let me just tell you, stocks were down today, bonds were up big, all right? And what got hit hard? Well, commodities got smashed. Oil was down 5.29%. This is a huge weighting in the CRB index. What else is going on around the block? KRE, new low. We talked about this yesterday. This is not something that I'd be hopping into. There's some people that are starting to say, yeah, this looks to me like it's capitulation. Well, good luck just jumping in it. I mean, you could get very lucky and it capitulates. But remember, Brian Shannon usually says this: if it doesn't scare you out, it's going to wear you out. And remember, this scared people out, wear them out, and then this probably really got them out. So if you're trying to catch bottoms, it's a very stinky business. We talked about the potential trend in change over here. It's still holding true. We had the potential change in trend over here in the NYSE summation index. That still holds true as well. We've been talking about bad breath, right? The S&P 500 matching highs, but the percent of stocks above the 50, 200, they've been declining. That's poor breath. You can even look at equal weight, right? High, lower high, high, matching high. That is poor breath. So equal weight has been moving down. So very few stocks been holding the S&P 500 up. We've also talked about back month versus front month volatility, right? The S&P 500, it's been just in a sideways channel, but it's been reaching back month way surpassing, right, front month to about 24%. That's that 1.24 over here, okay? Which is typically marked tops in, the bear market rallies that we've seen in 2022. We also talked about Dow theory in previous episodes, how everything was showing negative divergences, but the only thing that was moving up was industrials. That typically doesn't last for too long. Okay, so there's a lot of red flags obviously taking place, and the reason why I'm reiterating this again is just simply because you don't want to be blindsided, right? Yesterday's episode, we talked about, it's all going to look so obvious when we see this volatility. Not to state that there is going to be an event or a credit event or something bad is going to happen, but you don't want to be caught off guard. And that's why we do these shows, right? It's about saving your capital, protecting your capital. If you take a look at today's price action on the 15-minute time frame, we gapped down and we pretty much just blew down, right? I said yesterday that I was looking for a move to around the lower daily expected move, and I'll update these here momentarily. And then I was going to go into the smaller time frames to see if it starts basing out. Guess what? It did not base out. Guess what? It kept cutting through like a knife. Where did it land? It landed on the weekly expected move, and it wasn't up until about this point is when I was looking at it, and if you're in the Discord, you saw that announcement, where it started basing out, and from that point, we started to kind of gradually go up. Now the dynamic's shifting a little bit. Remember, we're still overall pretty neutral, but we're now below a 5-day moving average. We're below, the April low anchored VWAP, and we're below the week-to-date, month-to-date anchored VWAP there too as well. But no fret, we are still here inside the weekly expected move. So this was a large move today, a 2 sigma daily move. If you take a look at the Qs is also broke down out of its daily expected move. It came into the 5-day inclining moving average, and it did find support there, but it couldn't get back in. We've talked about this daily thing here. This is an interesting occurrence that when it breaks down strong and it comes back, sometimes it actually acts as like a flip. It acts as a level of resistance, whereas sometimes we've also seen it come down to it and it kind of bases out and then moves higher. But as it stands now, we're above the 5-day. We're getting between the 5-day and then the month-to-date, week-to-date anchored VWAP, sort of pinching there. So overall, relative strength in the Qs are actually doing quite well today. Now, if you want to screenshot this is the expected moves going into tomorrow. Let me just say this: they are big, right? You have the SPY looking at a plus or minus $4 expected move, roughly around the same there for the Qs as well. If we take a look at the zones here, by the way, these is something that I share daily with my Patreon group. It's only $9 a month, or you can do annually. It's $90, and I give a lot of stuff, which, by the way, speaking to my Patreons now, if you were looking at the trade ideas and you're looking at the zones, pay attention to the zone document, because on the miners section, right, we posted in the trade ideas a lot of miners because they were all setting up. Well, they took off, right, and now they're reaching up more into the red areas of the range. So it's consider updating your risk parameters to so you don't turn those winners into potential losers. Okay, overall, what took place at the S&P 500? We're back into the middle of the range. So 41.27 is the middle of the range. We closed slightly below that, and we're going into the Fed event, right? So that's kind of like, hey, it's uncertain, right? It's a little bit of a binary move. It's not giving us the clear vision that it was the other day, where it was like, hey, S&P 500 is red, where it had minimum upside but large percent downside. Well, we got that today. Even the VIX, right? It's a little bit on the high end, but it's still, just slightly above the middle of the range here. So we're also starting to notice some other of the sectors start to light up green, like Ruddy, right? RTY. We have crude oil that obviously got hit. We have KRE that obviously got slammed. XLE obviously got slammed because, well, oil got slammed. You have utilities that's on the lower end, and then you have financials too as well. And then obviously IWM, which is the Ruddy, which we already discussed. Let's go into the daily expected moves. Okay. Let's take a look here. So I zoomed out. This is the 15-minute time frame. These are the updated daily expect moves. Excuse me. Where have we gone? All right, where have we gone for over a month? We have gone nowhere, right? Nowhere at all. We literally, if I drew a line from here to here, right? It's been just sideways. And this is actually pretty interesting because I talked about that on this day, right? On, I think it was the weekend. Yeah, the weekend update, the weekly recap that we do. And we said basically, hey, it looks like it can potentially come up here, right? The 4,200, maybe it can potentially break away, but don't be surprised, right? Because we've been in this range that if it gets sucked right back down. And that's exactly what it does. Like it's anybody's game still here at this point, right? We have the bulls hanging out here, holding together this area, and we have the bears defending here in a very tight 100-point range. So if I go over here to the 15-minute time frame on the SPY, we're below the 5-day moving average. So if you want to be bullish, you got to get back above that. You want to be more bullish, you need to recapture the week-to-date, month-to-date anchored VWAP. And let me just tell you, we didn't really backtest this, so it's likely that we do at some point, but be very cautious because of the slope of the decline here. It could be hard to recover, or we get a little bit above it and potentially does a fake out, which happens all the time. This does look like it's potentially forming a bear flag, and if that is the case, it's likely we can go crack the potential daily expected move, or crack the weekly to touch the daily. So that is something to potentially pay attention to. We also have this gap there below us as well. But remember, overall, just kind of sideways price action. Another interesting thing here is on Bookmap. If you don't know what this is, well, this allows you to see kind of behind the candlesticks. All right, I talk about that often, where you can't see the order book. You need level 2 data. Level 2 data moves incredibly fast. Some people can read it. I cannot. I'm not that quick, so I like to use this software where it allows you to heat map where orders are. And let me just show you, this is ES, the S&P 500 today, and it started basing out at around that lower weekly expected move. And then take a look what hit the tape right over here. Boom, a big set of orders, right? This big old bid, very red, means it's a lot more orders over here. And then all of a sudden from this point, right? From that point, we started breaking out, and that's where we started finding, a little bit more movement to the upside. And then it was obviously pulled more towards the end of the day. Now, going into tomorrow for ES, 41.75 to the upside, and you can actually see some orders hiding out over there, 40.93 to the downside. There's actually orders all throughout the day over there, but they're not right there as of now. So if price starts breaking down, pay attention to 40.70 because those things came in, aggressively today on this big sell-off. And it'd be interesting to see if they come back and price wants to come and try to fill these out here. So that's going to be one to watch. And obviously that 4,100 level there too as well. Now, I want to go into the Qs really quick. The Qs is a pretty similar type story, right? We have this bear flag structure, but it's above that 5-day moving average. It's below the week to date, month to date. And then you have your lower and your upper daily expected moves. And the orange ones are your weekly expected moves. So remember, what I personally like to do is I like to just sit aside, let the Fed do its thing, let them answer the questions, let the market digest, and then go from there. Unless if there's a very clear contraction in the market where I can really enter in from a very positive risk to reward standpoint, I'll take the shot. But there's really just no need to try to guess because he could say anything at any moment and he could whip out positions intraday. I'm more talking for intraday traders overall. But if you are, say you are swing trading and you're looking at the SPY for a longer term, you still want to see price get above that 415. But just be mindful that the distribution days are starting to add up. Like this one is a distribution day. That one was a distribution day. They're starting to pile up. And the more distribution days you have, meaning more volume than the day before and the price went down, right? And price is overall going sideways here, it's more likely to break down at some point. So you just got to be cautious overall. That's all I got for you on today's episode, everybody. Have a wonderful Fed day.